Hey guys, so today in this video I really want us to talk about your finances, the foundation of a good financial plan, checking account, understanding the difference between checking accounts, savings accounts. You also have some less known options such as CDs, which is also GICs in Canada, and money market accounts. So we'll go over all these different options, different accounts. Hopefully by the end of the video you'll have a pretty good understanding of the landscape and general everyday type of accounts. And please guys, put a thumbs up on the video and maybe put a comment on ideas or other subject you'd like me to cover, and I'll make sure to get back to you. Also, subscribe really helps me. These three things doesn't seem like much, it takes a second, but it really helps. Learning about your finances is something that you should do as early on as possible, because it's compounding interest. The earlier you start thinking about it, the quicker you'll make more money, because it's not just about your income. Then it's once you have this income, what do you do with it? One thing that's gonna follow us throughout this video and other videos about finances and investment in general, it's fees. You really want to try to minimize fees that you are paying, whether it is monthly fees or if it's put into an account and you have some management fees. You really want to try to minimize all of these fees, because over time it's going to eat through your returns basically. For most of these things, the returns are not going to be big. So every $5-10 you can save a month is going to go a long way. And $5-10 a month, it doesn't sound like a lot. Over 1 year it's $60. Over 10 years it's $600. And with compound interest, if you were saving this $5 and instead reinvesting it into either high interest savings account or some kind of other investment vehicle, it will add up over time. So we'll first talk about checking account. Now, a checking account is basically an account where your bank will expect a lot of transaction, money coming in, money coming out, either paychecks and then you need to pay rent is going to come out. If you use your debit card to pay your groceries, that's coming out as well. That's where most of your funds will come in and most of your funds will come out. Usually checking accounts with a lot of banks and the bigger banks will usually come along with some kind of fee. For example, the one that I had at TD was a monthly fee. I think it oscillated between about $4, $10, even one was $16 a month. The one I had for many years, I was supposed to have a $10 a month fee in order to have added transaction as well as free e-transfers. After digging into online and other banks, there's some banks out there with zero fees, free transfers, as many transactions as you want in and out of your account for no fee, for free. Find these banks and open accounts with them, because over the long run, as I said, it's gonna save you a lot of money. Some of the banks that normally have these kind of monthly fee, sometimes they offer to waive the fee if you leave a certain amount of money at all times in this account. So for example, at TD, for the account that I used to have, that was $10 a month in fees. If you left at least $3,000 cash in this checking account, they were waiving the fee. So it might sound attractive because you don't pay the fee anymore, so that's nice. But if you do the math here, first of all, any money that's in your bank is using it, whether it is in checking account, savings account, anywhere it is, your bank is reinvesting it and making profit off of your back. Savings account, that's how they lend money to other people, to which they charge interest, and then they give interest back to you and keep a portion for themselves. Well, same thing, if you leave money in your checking account, they are not leaving it, in a drawer. They themselves will reinvest it in very safe and short-term type of investment, but it's still going to bring back some money back in their pocket, and you won't see any of that. If you leave $3,000 in your checking account, it might sound nice, but it's actually lost opportunity for you. If, let's say, you were to put $3,000 in, let's say, a high interest savings account that will return 2% a year, okay, that over 10 years, that would have returned to you about $700 over 10 years. So that's about $70 a year that you're losing on. Same thing, like if this $3,000 you were even investing into stocks and bonds at about 6%, this over 10 years, that's a lost potential revenue of $2,400. So that kind of goes to show over 10 years you would have lost a potential return of $2,400 by just leaving this money sit there and actually lose some of its value, because money in a checking account is basically money as if you had cash under your mattress. Because of inflation, this money is losing its value. So you really want to stay away from storing money in a checking account or under the mattress, simply because over time this amount of cash loses its value due to inflation. The benefit of a savings account is that it's a very safe type of place to store your money. It's insured, and you're just getting, a moderate, but yet still it is some interest, over the years, which will hopefully protect you from this inflation we talked about. So at least your money doesn't lose its value year over year. And if you do a good job finding a pretty high interest savings account, you might even make some profit on top of that and have your wealth grow year over year. Let's be fair, it's going to be small, but a small growth in wealth is better than stagnant or decreasing for sure. The savings account is for anything like cash that you might need in the short term. So first of all, there would be emergency fund. Now, does everybody need an emergency fund? Yes. Each individual would require more or less depending on their situation. For example, if you're a single person that's 30 years old, you could get away with 3 months, emergency fund. If you have 6 months, you're golden. Now, if you have a wife that maybe is not working, or even more so kids, then you really want to get at least to 6 months, if not more. Having an emergency fund allows you to keep putting a roof over your head, pay for rent, buy some groceries. So savings account is really for this emergency fund, as well as if you have a down payment for your house, you plan to buy your house, let's say in a year from now, savings account, high interest savings account can be a very good way, because you'll have access to that money 1 year down the line. It's not going to have lost some of its value as if you had, for example, invested in the stock market, let's say. Same thing if you want to buy a car, pay for a holiday, for example. Well, then you can put that money that you plan to be using within the next year into a high interest savings account. The other options you have available for this kind of like saving type of accounts, there's CD and GICs. So CD is for the US, so it stands for Certificate of Deposit, and GIC is the Canadian version, which it's a guaranteed investment certificate. And basically what a GIC is an agreement with your financial institution where you agree on a term, which is like the span of time where your money will be locked inside this account. And then you also agree on an interest rate that they're going to pay you over that set period. So you can have GICs for a 3 months period, but you can also get some for a year, 2 years, up to I think the maximum is 5 years. The benefit of these accounts is that once you sign this contract and your money is in there, at least you're assured that for the duration of that contract, you know that you will have this amount of interest coming in. So if you agreed on the 2.5% year over year, you know you're going to have this 2.5%, let's say, over 5 years, if that was the term that you agreed on. So at least that gives you some peace of mind, and as well it's very easy then for you to plan around that, because it's money that you know is going to come in at the end of the term. However, the downside of this type of account is that, as I said, the money is going to be locked inside this account. Now, in most cases, you can still take it out in case of a complete emergency, but you will pay fees, penalties for that, and usually it will just kind of like outweigh the benefit that the GIC would have brought you otherwise, will be eaten out by this fee. So really, if you go the GIC or CD route, make sure that you don't need that money for the duration of the term. Now, if you want to have some money coming in more regularly, you don't need to wait, let's say if it's a year or 2 years or whatever, you could decide to do a GIC with a 3-month term, and then another one, with a smaller portion of your money with a 6-month term, and one with 2 months term. That's called a ladder CD, to ladder your CD or ladder your GIC. So it's like more regularly you'll get money coming in instead of waiting all 5 years. So the benefit of these GICs is that usually, because your money is stuck in there for 5 years, your bank will be allowed, or financial institution will be allowed to take more risk with your money. If you lock it in for 5 years, they know they have 5 years to play with your money. They had more time to take higher risk. Whereas if it's a 3 months GIC, or if it's a saving account, because you could, put it in and the next day ask to get it back, they can't take as much risks. Usually a GIC or CD will have a higher interest rate than a high interest savings account, even though each situation is different, so you should really investigate yourself. Another benefit of the GIC is that, as we said, like, you lock in this interest rate for the duration of the term, whereas on a savings account and even a money market account, these accounts are kind of influenced by the economy. My savings account at TD, dipped down all the way to paying interest only of 0.1%. That's really not much. If instead I had secured, let's say in late 2019, a GIC over 5 years with interest, of maybe 2.5%, I would still be enjoying this interest rate, even though the bank, like, ideally they would, they wouldn't want to pay you that, but because you signed this contract, they are bound to keep giving you this nice interest rate for the duration of the term. Meanwhile, for savings account, they at any time they can dip it down as low as they want. So here in that case 0.1%, which kind of motivated me to look for other opportunities. And then I found Tangerine, for example, like in Canada, that is currently doing a very good promotion where for the first 5 months that you open an account with them, you will enjoy a 2.8% return, like interest return on your savings account, which is really the best out there currently. Now the last one that I would want to touch base, the last type of savings account, if I can call it this way, is a money market account. So this type of account is very similar to a high interest savings account, except that first of all you'll have usually a minimum amount that you need to open an account. So it might be $1,000 you need to put it up front, and if you dip down below this minimum amount, you will then pay some fees. Similarly, it's still possible to take out your money more easily than on a GIC. However, it's not as easy as on a savings account. So usually you have a maximum, like a limit number of withdrawal that you can do on this type of accounts. The benefit is that you might be able to find some money market account with a higher interest rate than savings account in general. But again, this will really depend, as sometimes some banks will come up with very good promotions on savings and high interest savings account. So that was the last type of account, I would say, like for really like the basic of your financial plan. Thanks for watching, guys. Please leave a comment down below with any question or subject you would like me to cover for the future videos, and I'll make sure to answer and potentially make videos on the subject you're interested in.